At its meeting that concluded early this month, the committee left the target range for the federal funds rate unchanged, but reiterated that it expects the evolution of the economy to warrant further gradual increases in the federal funds rate to achieve and maintain its employment and inflation objectives. As I noted on previous occasions, waiting too long to remove accommodation would be unwise, potentially requiring the FOMC to eventually raise rates rapidly, which could risk disrupting financial markets and pushing the economy into recession. Incoming data suggests that labor market conditions continue to strengthen, and inflation is moving up to 2%, consistent with the committee's expectations. At our upcoming meetings, the committee will evaluate whether employment and inflation are continuing to evolve in line with these expectations, in which case a further adjustment of the federal funds rate would likely be appropriate.
How important is a fiscal stimulus to the next interest rate hike?
So we don't know what fiscal plans will Congress and the administration will decide on. We're not basing our judgments about current interest rates on speculation about that. The economy has been making solid progress toward achieving our objectives. The unemployment rate is close to levels we regard as sustainable in the longer run. Inflation's moved up, and it's those trends that are driving our policy decisions and not speculation about fiscal policy. Also, remember, there are many factors that affect the economy. Fiscal policy may matter, but it's only one of many things we need to consider.
Why is the economy growing so slowly?
So the economy's potential to grow is largely determined by the growth of the labor force and by productivity growth, output per worker. And labor force growth has slowed. We have an aging population, and labor force growth is relatively slow. And productivity growth in recent years has been depressingly slow. So I guess over the last 6 years, business sector productivity has grown at an average of only 0.5% per year.
Okay, so let me ask you. I didn't mean to interrupt you, but I've just got 5 minutes. So it's labor, but we're at almost full employment, aren't we?
So the economy for a number of years has been growing faster than resource growth and productivity growth would have allowed. And the labor market has been tightening. Unemployment has been coming down, and labor market slack has been diminishing.
Right.
And
that should help the economy.
Well, it's enabled us to grow at roughly 2% a year, and the fact that labor market slack has diminished in the face of 2%.
Well, we've grown at 1.9%. You consider that acceptable for the American economy, strongest economy in the history of the world?
Well, when you say acceptable, I certainly wish it were faster.
Chair Yellen, in your view, as a noted labor economist, what impact would that have on our growth and competitiveness as a nation if we continue down the path of President Trump's massively expanding immigration? And along with that, what would be the consequences for our labor market and the price of goods and services?
So I'm not going to comment in detail on immigration policy. I think that's for Congress and the administration to decide. But I would say that labor force growth has been slowing in the United States. It's one of several reasons, along with slow productivity growth, for the fact that our economy has been growing at a slow pace, and immigration has been an important source of labor force growth. So slowing the pace of immigration probably would slow the growth rate of the economy.
Thank you.